Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering dividend stocks, the best dividend stocks going ex-dividend January 21st through the 25th, 2019. I posted 6 stocks that I made through the list over on Facebook, but we're going to be covering 5 in this article. So this week's 5 are ticker symbol CLX. This is Clorox Company. They're in the consumer goods sector. We have CVS. This is the CVS Health Corp within the services sector. We have ticker symbol LKFN. This is the Lakeland Financial Corp over in the financial sector. We have Lowe's Companies, ticker symbol LOW within the services sector. And we have ticker symbol WSM, and this is Williams Sonoma Inc., and this is within the services sector. We didn't have a whole lot of stocks going ex-dividend next week, so we do have some repeated sectors, which I try and have one stock from each sector, but this week there were only so many going ex-dividend, so these were the best 5 here on the list. Now, if you do enjoy these videos, these articles, and you want to get them in your email, you're able to subscribe to my blog by visiting the article. It's in the description below and also my website. And then you can also go ahead and share it on your Facebook, your Twitter, and wherever else on social media. Now, these stocks were screened for having starting yields over 1.5%, growing revenue, net income, free cash flow over the last 5 and 10 years, and they've all grown their dividend for the past 5 years or more. And of course, going into the future, they're all expected to grow their earnings per share into the future from where they have it now. Now, in these articles and in this video, we're going to be going over the ex-dividend date, the dividend payouts, the price comparison to the yield, PE comparison to the industry, the S&P 500, the payout ratio, dividend history, and more. And of course, if you haven't got started in your investment journey, I have links in the description below, as well as within the article. I have free applications that are available for calculating how many dividends you would receive over a period of time, 5, 10 years, and if you made weekly, monthly, yearly investments in your portfolio. And then I have another here, retirement calculator, which just calculates, you put in your age, when you want to retire, how much you want to have in income when you retire, and it's going to put out a plan of how much you need to invest weekly, monthly, yearly in order to hit that goal based off a 3% inflation and 7% annual return. Now, these stocks here are ordered by when they go ex-dividend. So there is a number next to them, but that does not represent whether they're number 1 or number 2 on the list. That is just when they are going ex-dividend from January 21st to the 25th, 2019. And of course, if you are brand new to the channel, have never been here before, hit that subscribe button below. I highly appreciate it. If you do enjoy the article, find it helpful, share it with your friends, hit that thumbs up. And of course, if you have any comments, questions, going over any of the stocks in the article, or want to share what stocks you are buying, drop them in the comment section, and I will always read and reply to them all. So let's go ahead and get into it. Number 1, we have ticker symbol LOW. This is Lowe's. It is a home improvement retail chain in North America. Lowe's operates over 1,500 stores, serving millions of customers weekly. Lowe's serves homeowners, renters, and commercial business customers, and is the second largest hardware chain worldwide, right behind Home Depot. They fall into the services sector. They're going ex-dividend on the 22nd of January, which is next Tuesday. You'd have to buy this stock on Monday or prior to be eligible for that payout on the 6th of February. Now here, I always like to present their 10-year chart. That way you can see their price, their revenue, their free cash flow, and their net income movement over the past 10 years. So in the blue, we have their price up 377% over the past 10 years. If you divide that by 10, that gives them an average return per year of 37.7%. It's a very nice return right there. In the red, we have their free cash flow at 520%, or 52% on average. In the green, we have their net income up 68%. And in the orange, we have their revenue up 47%, or roughly 4.7% on average per year. So very strong financials. Their revenue and net income are there in the 5-7% range. So very good growth for this services giant. Now, here is their 1 year information here. So what I like to show in their 1 year is their current earnings for the next fiscal year. So Lowe's is expected to pay out or have an earnings per share of $6.05. Now, of their earnings, their $6.05, they pay out 48 cents per share each quarter, or they pay out $1.92 per share each year. So they have lots of wiggle room there between their actual earnings and how much they actually pay out to their shareholders. They only pay out 37% of their earnings back out to their shareholders, so they have lots of wiggle room in order to increase future dividends and continue paying out that dividend. So Lowe's is currently priced at $96.90, which is slightly above their 200-day moving average. They are trading below their current dividend yield of 1.98%, so 1.84, 1.98 is currently where they are as far as a current dividend yield, depending on the day and the price of the stock. Now, their forward PE is 18.95, their price to book is 14.42, and their price to sales is 1.115. So, taking a look here at the graph above, we can see that the current stock price does have a price under the current yield, which may indicate it could be undervalued at this time. The stock is below the industry average, so here they're currently trading with a forward PE of 18.95. Their industry average is 19.8, so they are trading below the industry average, and they are also trading below the S&P 500 current average of 19.81. They're currently trading below their 60% payout ratio. They're trading at a 37% payout ratio, which gives them lots of wiggle room to increase it. If their earnings were to drop by 50%, they could still continue to pay out that dividend if for whatever reason. And this company, Lowe's here, has grown and paid out a dividend for the past 56 years since 1963. So their chance of cutting or freezing a dividend going into a recession is very unlikely. Now, their price to book value is fairly high here at 14.42, which is above that 3.0 value where asset-based companies would be considered a deal. But this is not an asset-based company. This is a price and sales-driven company. So here, their price to sales value is 1.11, which is below 3.0, where those sales and service-based companies would be considered a deal. So again, dividend yield roughly about 1.982%, depending on the day. You're going to get $1.92 back per share each year. Very low payout at 37%. They've grown and paid out a dividend for the past 56 years. Over the past 10 years, they've grown their dividend at a rate of 46.4% on average per year. And they've, again, paid out their dividend and raised their dividend back since 1963. So very reliable dividend here with Lowe's. So moving on here to number two. Number two, we have Clorox, ticker symbol CLX. The Clorox company is a consumer and an institutional product maker. Clorox operates in 4 business segments: cleaning, lifestyle, household, and international. Clorox offers hundreds of products, some of which include Clorox Bleach, Greenwork, Scoop Away, and more. So they fall underneath the consumer goods sector. Their ex-dividend is again next Tuesday, the 22nd of January. So you'd have to buy this stock on Monday or prior in order to be eligible. Hold it until the ex-dividend date, and then you'd be eligible for that payout on the 8th of February. Again, taking a look here at their 10-year, you can see that their price is up 187.8% over the past 10 years, or roughly 18.7% on average per year. So very good, strong price change there, beating out the S&P 500 return there. In the red, we have their free cash flow up 66%. In the green, we have their net income up 60%, or roughly 6% on average per year. And in the orange, the revenue is up roughly 13.63% over the past 10 years, or 1.36% over the past 10 on average per year. So their revenue is a little bit slow there. So they're, it's a giant company here. If you have to know the brand Clorox. They have so many products out there, the same as Johnson & Johnson and many others. These are just one of those name brand companies. You can probably find their items in your closet, in your bathroom, underneath the sink, underneath the kitchen. So very popular products there. So dropping down into their 1-year chart. So this company currently has a forward earnings per share of $6.73. They currently pay out 96 cents per share each quarter, or $3.84 per share each year. So here, $3.84 per share each year, and they make $6.73 on earnings per share. So that gives them about a 60% payout ratio. So there's not a whole lot of wiggle room here if they were to drop their earnings by half, but it's very unlikely that Clorox, a name brand product producer such as this, that would drop their earnings. So they are currently trading at $151.18. That puts them above their 200-day moving average of $140.74 and their current dividend yield of 2.46 to 2.54% yield. They do have a price to book here fairly high at 28.51, forward PE at 23.95, and a price to sales at 3.2. So again, when charted, it does show this current stock does have a price over the yield and the 200-day moving average, which may indicate it could be overvalued at this time. The stock is below the industry average, so here stock trades at 23.95. The industry average is 39, but it is above the S&P 500 current average of 19.81. So it's at a 60% payout ratio, and it has grown its dividend for the past 41 years. Since 1978, it has grown and paid out a dividend. So again, very recession-proof stock here. Price to book value is high at a 28.51, which is above 3.0, but this is not an asset-based company. This is a sales-driven company, so price to sales value is 3.2, which is still above 3.0, where sales and service-based companies would be considered a deal. So here, we've already seen that it's trading above price over yield for the year and above that 200-day moving average. It does have, it's currently trading above its industry average. It's trading above the S&P 500 average. It has a pretty high payout ratio, not extremely high. 60% is not too bad. But again, price to sales is also over 3.0. So this one does sometimes trade below that 3.0 value, and it also sometimes does correct here. You can see here for a time that yield did exceed the price. So if you had bought this back in May 2018, you would have got Clorox for around $110, $115, and that would have been the optimal time to purchase the stock, whereas now it does seem it has grown and grown a little bit too high there. So again, dividend yield 2.54, current annualized payout $3.84 per share, payout 59.9, which is basically 60%, and dividend growth for the past 41 years, growing their dividend for the past 10 years at an average rate of 10.8, and they've grown and paid out dividends since 1978. So very strong company. Clorox comes in at number 2. Number 3, we have ticker symbol CVS. CVS Caremark Corporation provides pharmacy healthcare services in the United States. CVS fills more than 1 billion prescriptions annually and operates in 3 business segments: pharmacy services, retail pharmacy, and corporate. They fall into the services sector. They're going ex-dividend next Thursday, the 24th of January. So you got to buy this stock on Wednesday or prior and hold it until Thursday, and then you'd be eligible for that payout on the 4th of February. Here, taking a look at their 10-year chart, you can see here that we do have a negative here in their net income, but this is all due to tax reform. Otherwise, they would be positive right now. So 2018, their tax reform, that did change the way that they're getting taxed here, and that made them appear to show negative. Johnson & Johnson also has done this. You have to do a little bit of math in order to get their true net income, but it's not actually into the negative here. So over the past 10 years, we can see that the price is up 144%, or roughly 14.4% on average per year. You can see here there was a period when it became a little bit overbought, and it has corrected back down to a fair, what could be considered fair there if you look at it that way. Now in the red, free cash flow up 147%. In the orange, revenue up 110%. Their revenue on average grows at 11% per year. So very strong revenue there. And their net income, without doing a little bit more math, this would be pretty hard to predict, but you can see that their trajectory was right in that 110, 114. So you could, if we probably did the math there, we could see that their net income probably increased at a rate of around 10 to 14% on average per year over the past 10 years. But just due to the tax reform, that does appear to show as a negative there. Dropping down into their 1-year graph, you can see here that CVS pays out, their earnings per share is expected to be $8.35. They increased it here going into 2019, so they are raising that earnings. They currently pay out 50 cents per share each quarter, or $2 per share each year. So $2 of their earnings gets paid out, and they get to keep $8.35. That gives them a very low payout ratio of 28.4%. So very, very low. They're currently trading at $65.32. That puts them below their 200-day moving average of $70.41 and below their current dividend yield of 3.06. So that is the correct yield right now. Their price to book, or their forward PE, is 8.7. Their price to book, 2.3, and price to sales is 0.35. So when charted, it does show the current stock does have a price under the yield and under the 200-day moving average, which may indicate it could be undervalued at this time. The stock is trading below the industry average. The industry average is 21, and it's at an 8.7 currently, and it's also below the S&P 500 at 19.81. So this company, again, has a payout ratio below 60%, very low payout ratio, 28.4. Dividend growth for the past 11 years, since 2008. I believe back in 2008 they actually froze out their dividend, but without double checking, I don't have it, in my memorized. Price to book here again, 2.3, which is below 3.0, where those asset-based companies, and price to sales is 0.35, which is very below that 3.0 value, where sales and service-based companies would be considered a deal. So CVS, they are a service company, lots of sales, so their price to sales ratio would be the one that you'd kind of emphasize off of here. And when they're trading at a 0.35, that is another indicator that they could be considered undervalued. But it's all for you guys to make your decision here. Dividend yield again, 3.06. Payout ratio, $2 per share each year. Payout ratio very low at 28.4. Grown their dividend for the past 11 years, since 2008, and they've increased their dividend on average over the last 10 years at rate a 5.5%. So that is number 3, CVS. Jumping down to number 4, we have Williams-Sonoma, ticker symbol WSM. Williams-Sonoma is a nationwide specialty retailer of high-quality products for the home. They market through their stores, online catalog, and multiple e-commerce websites. Williams-Sonoma offers many brands, which include Williams-Sonoma, Pottery Barn for kids, and many others. They fall into the services sector. They're going ex-dividend next Thursday, the 24th of January, just like the few others here. If you have to buy them on Wednesday or prior, hold them until Thursday, and then you'd be eligible for that payout on the 22nd of February. Here we can show their 10-year graph. In the red is their free cash flow, 900% or 90% on average per year. In the green, net income up 813% or 81.3% on average per year. Their price is up 541% or 54.1% on average per year. You can see that they've been trending sideways here since 2013. They've had some ups, they've had some downs, but they've mainly trended sideways since 2013. And in the orange, their revenue up 64% or roughly 6.4% on average per year. So this one, it doesn't show their pullback here in 2008. That would be something to look at. How have they recovered since that point? It does look like they came up 541% from that lows back in 2008 in January. So they've recovered very well since then. Dropping down to their 1-year graph, they currently pay out, you can see here that they've increased their earnings per share to now $4.45. They pay out 43 cents per share each quarter, or $1.72 per share each year. They're currently trading at $53.42, which puts them below their 200-day moving average of $57.72 and below their current yield of 3.22 to 3.14, just within that range. So their price is below their 200 and their yield currently. Their forward PE is at a 12.33. Their price to book 3.92 and price to sales here 0.8. So very sales driven company here. When charted, it does show the current stock does have a price under the yield and 200-day moving average, which may indicate it could be undervalued at this time. The stock is also trading below the industry average of 60.9 and below the S&P 500 rating there of 19.81. It does have a 39.6 payout ratio, which is below 60%, and has had dividend growth for the past 9 years since 2010, and an increase there over the past 10 years of 25.8%. Their price to book is high at 3.92, which is above 3.0, where those asset-based companies would be considered a deal. But this is, again, a sales and service-driven company here, so their price to sales ratio here of 0.08, I thought it was 0.8. So that's a 0.8, which is below 3.0, where sales and service-based companies would be considered a deal. So again, forward PE 12.33, industry 60.9, S&P 19.81, nice dividend yield of around 3.22%. They pay out $1.72 per share each year. Very low payout ratio, right around 40. Dividend growth since 2010. So not a 10-year currently, but very close. I would have to see what happened to them in 2010. Did they freeze it? Did they cut it? Did they, what exactly did they do back in 2010? That would be interesting. And that would be number 4, ticker symbol WSM. Number 5 here, our last and final stock, is ticker symbol LKFN. This is the Lakeland Financial Corp. They provide commercial, retail, and investment management services with over 45 locations covering northern and central Indiana. Their sector, of course, is financial. They're going ex-dividend along with the others here on the 24th of January. On Thursday, you'd have to buy this one on Wednesday or prior, and then you'd get that payout on the 5th of February. Here, we have their price up 191% or 19.1% on average per year. In the green, we have their net income up 285%, and the red, free cash flow up 255%, and their revenue here in the orange up 98% or 9.8% on average per year. So very strong financial metrics here for a financial. So very strong there. Price, revenue, free cash flow, net income, all in the double digits. They're almost, 10% there basically on their revenue. So almost all there in the double digits. Very strong financial. So they currently have an earnings per share estimate for the forward 2019 of 3.51. They pay out 26 cents per share each quarter, or $1.04 per share each year. They're currently trading at $43.10, which puts them below their 200-day moving average of $46.79, and their current payout of 2.42. So they're right in this range, 2.42 to 2.32. Their forward PE, 13.23. Price to sales is 5.9, but this is an asset-based company, as all financials are. This one has a 2.1 price to book value there. So taking a look here at the chart, it does show the current stock does have a price under the yield and their 200-day moving average, which may indicate it could be undervalued at this time. The stock is trading above the industry average here. Financials at a 12.3, and it's trading at a 13.23. It is also, it's also trading below the S&P 500 there of 19.81. It does have a low payout ratio of 34%. Dividend growth for the past 7 years since 2012. Their price to book 2.18. Price to book, which is below 3.0, where those asset-based companies. So financials are generally asset-based companies, and this one could be considered a deal. Price to sales, not too important for this one, 5.94. It is above 3.0, where those sales and service-based companies would be considered a deal. So stock, again, 13.23 for their forward PE, industry 12.3. Dividend yield 2.42. They pay out $1.04 per share each year. 34% payout ratio, very low. 7 years of growth, 15.1% on average over the past 10 years, and they've grown and paid out a dividend since 2012. So those are the 5 stocks. Again, starting from the top, just the ticker symbols. We have number 1, Lowe's, ticker symbol LOW. The Clorox Company, ticker symbol CLX. Number 3, CVS Caremark Corporation, ticker symbol CVS. We have Williams Sonoma, ticker symbol WSM. And we have Lakeland Financial Corp, ticker symbol LKFN. Those are the 5 stocks going ex-dividend next week. So if you guys did enjoy this article, visit it on my page, check it out. It's completely free. If you do enjoy it, of course, if you have other friends that are investors, they invest in dividend stocks or find them helpful and useful, share it with them. And a quick disclaimer, I am not a financial advisor, tax professional of any sorts. The information provided on this channel is my opinion for entertainment and fun. This is not, this is just me as a financial investor trying to help others make their money work for them. And if I had to pick one stock, in my opinion, I don't own any single one of these, nor do I plan on taking any sort of positions here in the next 3+ days. I have looked at CVS and Walgreens in the past. They both look like great buying points. I believe Walgreens actually did have a little bit less debt and more assets, but without comparing them side by side, I believe CVS would probably be my top choice, followed right behind by possibly Williams-Sonoma. But Colgate, I believe, is the most overpriced current one, the most overvalued one of the selection here. So drop it in the comment section. What do you guys think? What would you pick if you had to pick just one of these 5 stocks to invest in? Actually, I do own one. Quick disclaimer, I just added Lowe's to my portfolio, I believe, in December or January. So I do own Lowe's and will continue to hold and buy more Lowe's into the future. I just kind of saw it and remembered. That's not why it was on the list. It's a very strong company there that was going ex-dividend, so I made it through all the screening processes there. So that is basically my video here. If you guys did enjoy the video, hit that thumbs up button, share it with your friends. If you have any comments, questions going over any of the stocks, want to drop a comment as to what stocks you're buying, drop them in the comment section. And if you are brand new to the channel, a recurring viewer, hit that subscribe button below. I highly appreciate it. And that is it. Thank you all for tuning in. I will see you next time. Have a great day. Bye.